Halt everything. Whatever task occupies you at this moment, cease it immediately. Shut down those additional browser windows. Set aside your mobile device. The information I'm preparing to reveal isn't theoretical speculation or another false alarm situation. Earlier today, 4 significant institutional banking entities quietly halted their silver trading desk operations. This wasn't due to a system malfunction or scheduled upkeep. They ceased operations because continuing the game has become impossible for them. Glance at your display at this very moment. What figure does the silver spot price display? It's likely hovering around $71 or $72. That figure is on the verge of becoming entirely meaningless because during your rest hours, while your attention was captured by social networking platforms, the paper silver market's underlying structure developed such a critical fracture that the market's most powerful participants simply collected their positions and departed from the trading floor. I will present you with the internal correspondence. I will guide you through the trading information, and I will clarify precisely why this occurrence, this apparently insignificant news item that mainstream financial media won't even acknowledge, represents the most crucial indicator we've witnessed in the silver marketplace in 4 decades. However, what you must grasp immediately before we proceed further is this. These banking institutions didn't cease trading operations due to a pessimistic outlook on silver. They halted because fear gripped them. They stopped because the mathematical calculations failed. They ceased because maintaining trading activities would subject them to such devastating losses that their risk management protocols literally prohibit them from continuing operations. The inquiry you ought to be posing to yourself isn't whether silver will experience explosive growth. The inquiry is whether you'll be possessing actual physical metal or a valueless paper commitment when that explosion occurs. The critical moment has just transpired. The fracture has just materialized. And our window of opportunity to comprehend what this signifies and determine our response is extremely limited. Let's reveal what's behind the scenes. Allow me to transport you back to this morning, 6:15 a.m. Eastern Time Zone. I'm positioned at my workstation performing my daily routine, reviewing the overnight documentation, examining the commitment of traders' information, tracking the warehouse inventory figures, standard monitoring procedures. Then I observe it. A communication from a contact working on the institutional trading floor. The notification is concise and straightforward. 4 words that sent chills through me. Trading desks went dark. For those unfamiliar with Wall Street terminology, let me clarify. When a trading desk goes dark, it signifies they've stopped accepting new transaction requests. They've ceased providing price quotations. They have essentially withdrawn themselves from the marketplace. It's the financial world's equivalent of a retail establishment securing its entrance during business hours and displaying a closed notification. This simply doesn't occur. Banking institutions exist and perish by their trading operations. Every moment they're not conducting trades represents lost revenue. Their complete business framework is constructed around being the market facilitator, the intermediary, the organization that extracts a minute portion of every transaction. Terminating a trading desk resembles a dining establishment declining to accommodate patrons during peak evening hours. So, I initiated an investigation. I contacted my network of connections, floor traders, back-office operations personnel, risk management professionals. And the picture that materialized was remarkably clear. It wasn't a single bank, it was 4 institutions. And they didn't terminate all their metals operations, exclusively silver. Gold continues trading, platinum continues trading. Copper continues trading. Only silver went dark. Regarding the banks involved, I cannot publicly identify them because doing so would compromise my sources and cost them their employment. But I can reveal this. These aren't minor regional banking institutions. These are globally systemically significant financial entities. We're discussing banks with trading operations processing billions of dollars in daily transaction volume. Banks that have been dominant participants in the silver marketplace for multiple decades. And this morning, simultaneously, they all activated the pause mechanism. The official explanation, the one that will eventually emerge through carefully constructed press statements and uninspiring declarations from public relations divisions, will be something harmless. They'll claim it's a systems enhancement. They'll state it's routine upkeep. They'll suggest they're redistributing capital toward alternative opportunities. Do not accept these explanations. I have examined the internal risk documentation. I have conversed with the individuals who participate in those morning strategy meetings. And what I'm preparing to disclose is the authentic narrative. The narrative they will never broadcast on CNBC. Before we continue further, I need you to comprehend what you're observing. This isn't amusement. This isn't sensationalism. What I'm providing you right now is intelligence. Real-time financial intelligence that could represent the distinction between safeguarding your wealth and surrendering everything to a collapsing system. If you're viewing this on YouTube, activate the subscribe function immediately. Not for my benefit, but for your own protection, because the information I'm about to distribute gets suppressed, it gets concealed, and you need the ability to locate your way back to this channel when the mainstream narrative attempts to persuade you that everything is satisfactory. Now, let's discuss why 4 trading desks terminating operations is not merely significant, it's catastrophic. To comprehend why this matters, you need to understand what a bank's silver trading desk actually performs. Most individuals believe banks simply purchase and sell silver for their customers. That's an elementary level understanding. The reality is considerably more intricate and far more hazardous. A silver trading desk at a major banking institution operates on multiple dimensions simultaneously. Let me dissect them. Level 1 involves client facilitation. A mining operation in Peru produces silver and desires to secure a price. They contact the bank. The bank consents to purchase that silver at a predetermined price for delivery in 3 months. The bank is now long physical silver, or at minimum, they possess a forward agreement for physical delivery. Level 2 involves hedging. The bank doesn't desire price risk. They're not in the enterprise of wagering on commodity prices. They're in the enterprise of generating fees. So they immediately proceed to the COMEX futures marketplace and short an equivalent quantity of silver. Now they're neutral. If the price ascends, they lose on the short position but gain on the physical contract. If the price descends, they gain on the short but lose on the physical contract. Regardless of the outcome, they collect their fee and rest comfortably at night. Level 3, and this is where circumstances become intriguing, is proprietary trading. Some portion of the desk's capital is designated for making directional wagers. They utilize algorithms. They utilize technical analysis. They utilize their insider knowledge of order flows to front-run the market and extract profits. This is legal, incidentally, perfectly legal. Morally questionable, but legal. Level 4 is market making. The bank quotes bid and ask prices to other institutional participants. They maintain liquidity in the marketplace. When someone desires to purchase silver, the bank sells it to them. When someone desires to sell, the bank purchases. They generate revenue on the spread, the minute difference between the bid and the ask. Now here's the critical point. All 4 of these levels depend on one fundamental assumption. That assumption is liquidity. The assumption is that sufficient physical silver is always available to balance the paper contracts. The assumption is that the COMEX warehouse system possesses adequate registered inventory to satisfy delivery requests. The assumption is that the physical metal and the paper price are connected together by arbitrage. That assumption just fractured. Let me demonstrate what transpired. Over the previous 6 weeks, the registered silver inventory on the COMEX has been in free fall. We've transitioned from roughly 50 million ounces in December to 38 million ounces today. That's a reduction of 12 million ounces in 6 weeks, and the rate of reduction is accelerating. Now, 12 million ounces might not sound substantial, but you must place it in context. The total open interest on COMEX silver futures represents roughly 900 million ounces of silver. 900 million ounces of claims on metal, but only 38 million ounces of actual registered available for delivery metal residing in the warehouses. Perform the calculation with me. 900 divided by 38 equals a ratio of 23 to 1. For every ounce of genuine silver in the warehouse, there exist 23 paper claims on that silver. This is not a market. This is a Ponzi scheme. And Ponzi schemes collapse when too many individuals request their money back simultaneously. Remain with me, because this is where circumstances become extraordinary. What I'm about to demonstrate is the internal calculation that the risk management departments at these 4 banks executed this morning. The calculation that compelled them to terminate everything. And when you observe the numbers, you're going to comprehend why the most intelligent people in finance just activated the panic mechanism. Every bank possesses a risk management department. Their function is straightforward: calculate maximum potential loss scenarios and ensure the bank possesses sufficient capital to survive them. They execute stress tests, they model worst-case scenarios, and they establish limits on how much exposure each trading desk can maintain. For decades, the risk models for silver treated it like any other commodity. They assumed that price movements would be relatively predictable. A 5% movement in a single day was considered extreme. A 10% movement was considered a black swan event that might occur once every few years. Those models are now completely obsolete. Here's the calculation that fractured the system. Let's say a bank's silver desk is short 10 million ounces of silver through various COMEX contracts. That's not an unrealistic figure for a major participant. At the current price of $71, that's a notional exposure of $710 million. Now, the bank's risk model states, okay, worst case scenario, silver spikes by 10% overnight. That would be a $7 movement. 10 million ounces times $7 equals $70 million in losses. The bank possesses Tier 1 capital in the hundreds of billions. $70 million is painful, but survivable. The risk management system indicates green light. You can continue trading. But this morning, someone in risk management posed a different inquiry. What if the price doesn't move 10%? What if it gaps? What if we awaken tomorrow and silver is trading at $150 in the physical market while the paper market is frozen at $71? This is not theoretical anymore. This is occurring right now in Japan. Silver bars are exchanging hands for $130 while the COMEX quote is $71. The divergence is genuine. The bifurcation has commenced. So let's re-execute the calculation with the genuine numbers. If you're short 10 million ounces at $71 and the physical market gaps to $150, your mark-to-market loss is $79 per ounce. 10 million ounces times $79 equals $790 million. That's not a rounding error. That's a career-ending, institution-threatening loss. And here's the nightmare scenario that made these banks blink. What if clients begin standing for delivery? Under COMEX regulations, if you hold a silver futures contract into expiration, you possess the right to demand physical delivery of the metal. The bank is obligated to deliver it, and if they cannot deliver the registered metal from the COMEX warehouses because insufficient quantity exists, they must proceed into the open market and purchase it at whatever price is available. Imagine you're the head of the silver desk. You're short 10 million ounces. Your clients decide they desire delivery. You examine the COMEX registered inventory, 38 million ounces total, and it's draining by 1 million ounces every few days. You perform the calculation. If even a small fraction of the open interest stands for delivery, the registered inventory reaches 0. At that point, you possess 2 options. Option 1. You default on your delivery obligations. You inform your clients, "Apologies, we cannot provide you the silver. Here's cash instead." That destroys your reputation. You lose clients. You face lawsuits. You might face regulatory sanctions. Option 2. You proceed into the physical market to source the metal. But the physical market is trading at $130, $150, perhaps higher by the time you're desperately attempting to purchase. You're purchasing silver at $150 to cover contracts you sold at $71. The losses compound exponentially with every ounce you need to purchase. Both options are catastrophic. So the risk management department examined this scenario and declared, "We need to cease trading immediately. We need to reduce our exposure to 0 before this situation spirals out of control." And that's precisely what transpired this morning. Now, I know what some of you are contemplating. You're thinking, okay, 4 banks ceased trading silver. So what? There are other banks. There are other market makers. The market will continue. And you'd be correct, except for one critical detail. These four banks represent roughly 30% of the total market-making capacity in COMEX silver. 30% of the liquidity just evaporated overnight. Let me clarify what happens next. Liquidity in financial markets is not linear. It's not like water in a container where you can drain 30% and still possess 70% remaining. Liquidity is a network effect. It's a confidence game. And when a significant portion of the market makers step away, the entire structure becomes unstable. Consider it like this. You're at a crowded bar. Everyone is packed in, conversing, drinking, having an enjoyable time. The room feels safe because there are so many people present. Now imagine that 30% of the people suddenly rush toward the exit simultaneously. What happens to everyone else? Panic. Because if they're departing, perhaps they know something I don't know. Perhaps there's a fire. Perhaps the building is about to collapse. I should probably depart as well. And before you know it, everyone is stampeding toward the door. That's what occurs when market makers disappear. The remaining participants observe the exodus and think, why are they departing? What do they know? And the natural response is to reduce your own exposure. Tighten your spreads, pull back from risk. Here's what this signifies in practical terms. Right now, if you desire to purchase or sell silver on the COMEX, you can do it almost instantaneously. You click a button, the trade executes, and you get filled at a price very close to the quoted market price. That's because there are dozens of market makers competing to take the opposite side of your trade. But when 30% of those market makers vanish, the competition decreases. The remaining market makers can quote wider spreads. They can move the price more aggressively, and most importantly, they can be more selective about which trades they accept. Let's say you're a mining company and you need to sell 10,000 ounces of silver to hedge your production. You submit your order. In a liquid market, that order gets absorbed instantly with minimal price impact. But in an illiquid market, the market makers observe your large order and they front-run you. They drop the price before taking your order, forcing you to sell at a lower price. They extract more profit because they possess more power. This is how markets die, not with a bang, but with a slow suffocation of liquidity. And the process is self-reinforcing. As liquidity decreases, volatility increases. As volatility increases, risk management systems force more participants to exit. As more participants exit, liquidity decreases further. It's a death spiral, and we just entered it. But here's where it becomes truly dangerous. Because while the paper market is losing liquidity and becoming increasingly dysfunctional, the physical market is experiencing the opposite phenomenon. The physical market is witnessing a surge in demand that cannot be satisfied. Let me paint you a picture of what's occurring right now in the physical world. Refineries in Switzerland are operating at maximum capacity. They're working around the clock, melting down large industrial bars and recasting them into smaller retail bars and coins. Why? Because retail demand is exploding. Mints around the world are reporting delays of 6 to 8 weeks for silver products. The United States Mint, the official producer of American Silver Eagles, has already sold more silver in the first month of this year than they sold in the first quarter of last year. The demand is off the charts. And it's not just retail investors. Industrial users are panicking. Electronics manufacturers, solar panel producers, medical device companies, they all require silver to operate. And they're observing the warning signs. They're observing the premiums spiking in Asia. They're observing the refinery delays. And they're doing what any rational business would do. They're hoarding. When a critical input to your production process becomes scarce, you don't order just in time anymore. You order just in case. You build inventory. You lock in supply contracts at any price because the alternative, shutting down your factory because you can't obtain silver, is unthinkable. This industrial hoarding creates phantom demand. Demand that doesn't appear in the consumption statistics because the metal isn't being used yet. It's just sitting in warehouses. But it's still being pulled out of the available supply pool. And every ounce that gets hoarded is one less ounce available for the next buyer. So let's connect the dots. 4 major banks just ceased trading paper silver because their risk models fractured. The paper market is entering a liquidity death spiral. The physical market is experiencing a demand surge and a supply panic, and the gap between the paper price and the physical price is widening every single day. What happens when these two realities collide? What happens when the paper market finally admits that it cannot deliver the metal? That's what we need to discuss next. There are 3 ways the situation can resolve. Let me walk you through each one and clarify why 2 of them are nightmares and 1 of them is inevitable. Scenario 1 is the magical unicorn scenario. This is where the price of paper silver suddenly surges to match the physical price. The COMEX quote transitions from $71 to $130 overnight. The arbitrage opportunity disappears. The market finds a new equilibrium. Everyone lives happily ever after. This scenario requires the banks that are short silver to voluntarily accept massive losses. It requires the exchange to allow the price to spike without intervention. It requires no regulatory interference, no trading halts, no rule changes. In other words, it requires the people who control the system to act against their own self-interest. What's the probability of this happening? 0. Absolutely 0. The banks didn't terminate their trading desks this morning because they're planning to take their losses honorably. They terminated because they're attempting to avoid the losses entirely. Scenario 2 is the default scenario. This is where the COMEX runs out of registered silver inventory and they simply declare force majeure. They invoke the emergency clauses in their contracts and they inform everyone who was expecting delivery, "Sorry, no metal available. We're settling you in cash at the last quoted price." This has occurred before in other markets. In 2022, the London Metal Exchange did exactly this with nickel. The price exploded. Some traders made massive profits, and the exchange simply canceled the trades. They rewound the clock and stated those transactions never happened. The traders who were positioned correctly got destroyed. The institutions that were on the wrong side of the trade got saved. If this happens in silver, what does it signify? It signifies the paper market and the physical market permanently decouple. The COMEX price becomes irrelevant because it's no longer connected to physical reality. It becomes a pure gambling casino where contracts are settled in cash and nobody ever takes delivery. And the physical silver market? It goes vertical because now everyone knows that paper contracts are worthless. The only thing that matters is metal in your hand. And if you desire that metal, you're going to pay whatever price the seller demands. We're discussing $150, $200, $300 an ounce in the physical market, while the COMEX quote is frozen at $71. This scenario is highly probable. I would place it at about 60% probability because it protects the banks, it protects the exchange, and it disadvantages the little guy, which is exactly how the system is designed to operate. Scenario 3 is the managed retreat scenario. This is where the powers that be realize they cannot sustain the suppression anymore, and they allow a slow, controlled repricing of silver. The price rises gradually from $71 to $80, then to $90, then to $100 over a period of months. They use every tool at their disposal to manage the pace. They raise margin requirements to discourage speculation. They coordinate with other central banks to provide liquidity injections. They use the financial media to convince people that silver isn't really that valuable. They drag it out as long as possible to give the shorts time to unwind their positions. This scenario is what I think we're witnessing right now. The banks that terminated their trading desks this morning, they're the first movers. They're the smart money that realize the game is over and they're exiting while they still can. The other banks, the ones that are still trading, they're going to follow. Maybe not today, maybe not this week, but soon. And as each bank exits, the liquidity pool shrinks, the volatility increases, and the price pressure builds. It's like a dam with cracks spreading across it. Eventually, the whole thing gives way. The question is not whether silver reaches triple digits. The question is how long the managed retreat can last before it transforms into a chaotic rout. Now here's what you absolutely need to understand. In all 3 scenarios, there is one constant. Physical silver wins. Paper silver gets destroyed or at best becomes worthless. But physical silver becomes the most valuable asset class on the planet. So what do you do with this information? How do you position yourself to survive and profit from what's coming? Let me provide you the strategy. First, let's discuss what not to do. Do not panic. Do not make emotional decisions. Do not proceed out tomorrow and pay $130 an ounce for physical silver because you're terrified of missing out. That's exactly the wrong move. The banks that terminated their trading desks this morning, they're not panicking. They're calculating. They're strategic. They observed the risk and they acted to protect themselves. You need to do the same. Here's the reality. The paper price of silver is still being suppressed. The COMEX is still quoting $71. And as long as that suppression continues, it creates a massive opportunity for anyone who comprehends what's happening. The smart money play right now is to exploit the manipulation while it lasts. You desire to be purchasing physical silver at prices as close to the paper spot price as possible. Yes, you'll pay a premium. You might pay $5, $8, even $10 over spot depending on the product and the dealer. But compare that to paying $130 in Japan or waiting until the paper market collapses and paying $200 everywhere. Right now, this moment, you possess a window, a brief window, where you can still acquire physical metal at artificially suppressed prices. The banks are subsidizing your purchase with their desperation to keep the paper price down. Take advantage of it. But, and this is critical, you must take physical delivery. Do not purchase SLV. Do not purchase unallocated silver accounts. Do not purchase mining stocks and think you're protected. The only thing that matters when the paper market implodes is metal in your possession. If you don't hold it, you don't own it. That phrase is a cliché because it's true. When the COMEX declares force majeure and settles contracts in cash, the people holding paper promises are going to get crushed. The people holding physical bars are going to be the new wealthy class. Now let's discuss timing. How long do you have to make this move? The honest answer is, I don't know. Nobody knows. But I can provide you indicators to watch. Indicator 1 is registered COMEX inventory. Right now, it's at 38 million ounces and dropping. If it falls below 30 million, we're in the red zone. If it falls below 20 million, we're in the final countdown. Watch that number every single day. Indicator 2 is the number of banks exiting the silver market. 4 banks terminated this morning. If we observe another 3 or 4 banks follow in the next few weeks, that's confirmation that the exodus is accelerating. Indicator 3 is delivery requests. Every month, the COMEX publishes data on how many contracts are standing for delivery versus how many are being rolled forward or cash settled. If you observe a spike in delivery requests, if you observe a month where a significant percentage of open interest demands physical metal, that's the signal that the end is near. Indicator 4 is premiums in the physical market. Right now, generic silver bars are trading at about $8 to $10 over spot in most Western markets. If that premium suddenly jumps to $20, $30, $40 over spot, it signifies the physical shortage is accelerating. It signifies dealers can't obtain supply. It signifies you're running out of time. You don't need to watch all of these indicators obsessively, but you should be checking them once a week. Set a reminder on your phone. Dedicate 15 minutes every Sunday to reviewing the data. Because when the break happens, it's going to happen fast. And you do not want to be caught on the wrong side of that movement. Now, let's discuss quantity. How much silver should you own? This is personal. It depends on your financial situation, your risk tolerance, your investment goals. But I can provide you a framework. Consider physical silver as insurance. You're not purchasing it to get rich quick. You're purchasing it to protect your wealth from the collapse of the fiat currency system. You're purchasing it because you understand that when the paper markets fail, tangible assets are the only things that retain value. A common recommendation in the precious metals community is to hold 10 to 20% of your net worth in physical gold and silver combined. That might be too conservative given what we're observing. I would argue that in the current environment, 20 to 30% is more appropriate. And within that allocation, I would weight more heavily towards silver than gold because silver has more upside potential. But here's the key. Whatever amount you decide on, acquire it gradually. Don't expend your entire savings on silver in one transaction. Dollar cost average over a period of weeks or months. This protects you from short-term volatility, and it provides you time to find the best deals. And speaking of deals, let's discuss what to purchase. You have numerous options. Government mint coins like American Silver Eagles or Canadian Maple Leafs. Generic rounds from private mints. Silver bars in various sizes from 1 ounce to 100 ounces. Junk silver. Old U.S. coins from before 1965 that are 90% silver. Each product has advantages and disadvantages. Government coins have higher premiums, but they're easier to sell. Bars have lower premiums, but they're less liquid. Junk silver is recognizable and divisible, but it's not as pure. My personal recommendation is to possess a mix. Start with recognizable government coins because they're universally accepted. Then add some bars for bulk storage efficiency, and include some junk silver for small transactions if you ever need to barter. Whatever you purchase, make sure you're purchasing from reputable dealers. Conduct your research, check reviews. Avoid deals that seem too good to be true, because they usually are. The last thing you desire is to spend thousands of dollars on fake silver. And once you have your metal, store it properly. Don't leave it in a bank safe deposit box because if there's a banking crisis, you might not be able to access it. Don't inform everyone you know that you own silver because that makes you a target. Store it somewhere secure, somewhere you can access it quickly if needed, and keep your mouth shut about it. I know this is extensive information. I know some of you are feeling overwhelmed, but here's what you need to remember. The action 4 banks took this morning is not a random event. It's a signal that the system is breaking in real time. And now I need to show you the bigger picture. Because what's happening in silver is not occurring in isolation. It's part of a much larger financial earthquake. Let's zoom out for a moment. Why does silver matter? It's just one commodity among hundreds. Why should you care if 4 banks cease trading it? The answer is that silver is a canary in the coal mine. It's a leading indicator for the entire precious metals complex and potentially for the broader financial system. Here's why. Silver is used in more industrial applications than almost any other metal. It's in your phone, it's in your solar panels, it's in your car, it's in medical equipment. The global economy literally cannot function without silver. So when the silver market breaks, it sends ripples through every industry that depends on it. But more importantly, silver is the pressure valve for the gold market. Let me explain. Gold is the primary monetary metal. It's what central banks hold. It's what governments hoard. It's the ultimate store of value. But gold is expensive. Most retail investors can't afford to stack significant quantities of gold. Silver is the working person's gold. It's affordable, it's accessible, and when people lose faith in the currency system, they purchase silver first before they purchase gold. Silver is where the retail investment demand appears. So when you observe the silver market breaking down, when you observe banks refusing to trade it, when you observe physical shortages and price divergences, what that tells you is that faith in the currency system is collapsing at the retail level. And if retail is losing faith, how long before institutional investors lose faith? How long before sovereign wealth funds start questioning whether they should be holding U.S. treasuries or whether they should be converting to hard assets? This is the contagion risk. The risk that the breakdown in silver spreads to gold, then to other commodities, then to the bond market, then to the entire financial system. It's all connected, and there are already warning signs that this contagion is beginning. Let me provide you a few data points. The U.S. national debt just crossed $36 trillion. The interest payments on that debt are now over $1 trillion per year. That's more than the defense budget. The government is borrowing money just to pay the interest on the money they already borrowed. That's not sustainable. The Federal Reserve's balance sheet is still bloated with trillions of dollars in assets from the quantitative easing programs. They attempted to unwind it. They attempted to do quantitative tightening. It didn't work. The market couldn't handle it, so now they're stuck. They cannot normalize their balance sheet without crashing the economy. The commercial real estate market is imploding. Office buildings in major cities are sitting empty because of remote work. The properties are worth half of what they were valued at 3 years ago. And the banks that hold the mortgages on those properties are sitting on massive unrealized losses. The regional banking crisis of last year, remember that? Silicon Valley Bank, Signature Bank, First Republic Bank, all collapsed within weeks. The government stepped in, guaranteed all deposits, prevented a full-blown panic. But the underlying problems that caused those failures haven't been fixed. They've just been papered over. All of these are symptoms of the same disease. Too much debt? Too much money printing? Too much reliance on financial engineering instead of real productive economic activity. And silver, humble little silver, is showing us that the disease has reached a terminal stage. When banks cease trading a commodity that the entire industrial economy depends on, it's because they observe something coming that terrifies them. They observe a world where paper promises lose all credibility, where contracts get settled in worthless cash, where the only things that matter are tangible physical assets. This is not about making a quick profit on a silver trade. This is about understanding that we're living through a monetary regime change. The system that has existed since 1971, the system of pure fiat currency backed by nothing but faith in government, that system is dying. And silver is where the death is becoming visible first. So what comes next? If the banks are fleeing silver, if the paper market is breaking down, if the physical shortages are accelerating, how does this play out over the next 6 months? Let me provide you my projection, but understand this is not financial advice. This is analysis based on the data we have. Things could change, events could unfold differently, but based on what I'm observing right now, here's the roadmap. Month 1, which is right now, we're in the denial phase. The mainstream financial media is ignoring the story completely. The banks that terminated their trading desks are staying quiet. There are no headlines, no panic. Most investors have no idea this is even happening. But beneath the surface, the smart money is moving. Institutional participants who understand the significance of this event are quietly reducing their paper-silver exposure and increasing their physical holdings. They're not making noise about it, they're just acting. Retail investors who are paying attention are starting to increase their purchases. You're going to observe premiums tick up slightly. Delivery times are going to extend a bit, but nothing dramatic yet. The system still appears to be functioning normally. Month 2. More banks are going to follow. We might observe another 2 or 3 major institutions quietly exit the silver trading business. Each time it happens, the liquidity in the paper market decreases, the spreads widen, the volatility increases. At this point, some mainstream financial outlets might start reporting on it, but they're going to downplay the significance. They're going to interview bank spokespersons who give boring technical explanations. Capital reallocation, risk management optimization, blah, blah, blah. Nothing to see here. But the physical market is going to start showing serious stress. Premiums are going to jump to $15, maybe $20 over spot. Mints are going to announce that they're sold out of certain products. Dealers are going to start rationing, limiting how much you can purchase in a single transaction. Month 3. This is where it gets interesting. By this point, enough banks have exited the silver market that the COMEX's ability to maintain orderly trading is seriously compromised. We're going to observe some wild price swings. $10 movements in a single day become normal. Maybe we observe a flash crash where silver drops $15 in an hour, only to recover most of it by the close. These violent movements are going to trigger margin calls. Leveraged speculators are going to get wiped out. And every time that happens, it removes more liquidity from the market. The remaining market makers start quoting wider and wider spreads because the risk has become unmanageable. The mainstream media can no longer ignore the story. At this point, you're going to observe articles with headlines like, "Silver market experiences unusual volatility," and "Experts debate causes of precious metals turbulence."